In this video, I'm talking about 401k rollover mistakes to avoid. Today's vlog is being brought to you by 401k Maneuver. 401k Maneuver provides online professional account management with the goal of supercharging your 401k account performance. So stop leaving money on the table each and every year in the form of lost returns. Let us help you. That's real money, you guys. If you're new here, be sure to hit the subscribe button, and the links to everything that I mentioned in this video you can find in the description box below. So let's jump right in. Whether you've lost your job or plan on changing jobs in the near future, there are common 401k rollover mistakes that you need to be aware of. Ignore these and a rollover could take a chunk out of your retirement savings, trigger a big tax bill, and impact the quality of your retirement. So keep watching for the top 401k rollover mistakes and how to avoid them. Let's first talk about 401k options when leaving a job. Here are the options on what you can do with your 401k when you leave a job. First, leave the money behind in your former employer's 401k plan. You don't have to, but you can, and we'd advised against this option unless you qualify for the 55 and separated from service rule. Next, roll over your 401k into an individual retirement account. This option has many advantages, including consolidating more than one 401k account into an IRA. This works well for those with a string of old 401k accounts. Next, you could roll over your old 401k to your new 401k if permitted by your new employer. And if you have at least $5,000 saved in your old 401k, most companies will allow you to roll it over. Last, you could cash out your 401k. This is a costly option we advised against because you will face penalties and pay taxes for cashing out before age 59 and a half. Now let's pivot and talk about costly rollover mistakes. What seems like a simple misunderstanding could possibly turn into a costly 401k mistake that could take a chunk out of your retirement savings. This costly mistake lies in understanding the two types of rollovers. First, the direct rollover. With a 401k direct rollover, the transactions occur directly between the custodian of your old 401k plan and the custodian of your new 401k plan, your IRA, Roth IRA, or annuity. There are no penalties or taxes that have to be paid with a direct 401k rollover because it is what's called a trustee to trustee transfer. Now let's talk about indirect rollover. With an indirect 401k rollover, you receive a distribution check from your 401k plan, and then to complete the rollover transaction, you must make a deposit into the new retirement plan within a 60-day period. And if you don't, it's treated as a distribution and you will pay taxes on that amount. Indirect rollovers may be a huge mistake if you don't follow the rules, but it's just one of many. So keep watching for the common mistakes so you can avoid them at all costs. First, doing an indirect rollover incorrectly. With an indirect 401k rollover, you receive a distribution check from your 401k plan, and then to complete the rollover transaction, you must deposit the funds into the new retirement plan. And unlike the direct rollover, 20% taxes are withheld from every indirect rollover, whether you plan to roll over the funds or use the money to pay off debt or make a purchase. The IRS mandates that your 401k custodian withhold this amount, so you get a check mailed to you minus the 20% of taxes. After you receive the check, you are required to put those funds along with the missing 20% in a new retirement account within 60 days. And you will be able to recover the withheld taxes when you file your tax return, but to complete the rollover, you need to produce that extra cash. And if you fail to do so by the 60-day deadline, your distribution will be taxed as ordinary income and subject to a 10% early withdrawal penalty if you're under the age of 59 and a half. So this means if you miss the 60-day deadline or decide to cash the check, you may be forced to pay a 10% penalty in addition to the 20% tax. And here's how costly this could get. Let's say you do an indirect rollover of your $10,000 total 401k balance before age 59 and a half, and you miss the 60-day deadline to roll over your funds. You will have 20% withheld in taxes along with a 10% penalty for an early withdrawal. And this means that you might only get to keep $7,000 of your original $10,000 401k balance depending on your tax bracket. See how quickly this could eat away at your hard-earned savings? Number 2, leaving your old 401k behind. Leaving behind 401ks with past employers happens more often than it should. And according to Capitalize, the number of forgotten 401ks increased by over 20% since May of 2021, driven by a period of heightened job switching, which is called the Great Resignation, with 3.8 million and 4.4 million accounts left behind in 2021 and 2022 respectively. And based on their findings, this equates to 1 in 5 job changers leaving a 401k account behind when changing jobs. Now, it may seem easy and safe, but that's not always the case. It is your money, not your former employees. And that means your past employer cannot manage your old 401k for you. Leaving behind an old 401k means your account will remain subject to plan rules and you will continue to have limited investment options. This often results in your retirement funds not suiting your risk tolerance and may lead you to miss out on potential gains or avoiding losses. Bottom line, when you aren't engaged with your 401k, your money won't work for you like it should. Do yourself a favor, check out the complimentary read in the description box below titled The Danger of Forgetting to Roll Over Old 401ks. Next, let's talk about rolling over your 401k too early. There is an IRS rule that, if you qualify, may help you to have more money and avoid penalties that could eat into your retirement income. It's called the 55 and separated from service rule. It's also called the Rule of 55 or 55 rule. This IRS provision allows you to take penalty-free distributions on your 401ks if you leave your job during or after the calendar year you turn age 55. And if you want to retire early or lose your job and need cash flow to cover daily expenses while you look for another job, this rule allows you to take distributions sooner than is typically allowed. Now keep in mind, you will still owe ordinary income tax on the amount you withdraw, but you can avoid the 10% IRS early withdrawal penalty. Check the description box below for a complimentary read titled When It May Not Make Sense to Roll Over Your 401k. Number 4, let's talk about taking company stock with you. Does your 401k contain shares of your former employer's stock? If so, be careful. Rolling over stock that has appreciated over the years may wind up costing you. A special rule called the Net Unrealized Appreciation or NUA rule applies when you receive a tax distribution of employer stock from your plan. According to this rule, you will only pay ordinary income tax on the cost basis of the stock, which is the stock price at the time the plan purchased it for you. Any appreciation in the stock will receive more favorable long-term capital gains treatment. However, this rule does not apply if you roll over the stock to an IRA. The NUA rules must be utilized as part of a full and final rollover from an employer plan. The NUA rules must be utilized as part of a full and final rollover from an employer plan. Things you should know before you roll over your 401k. Understanding all of your rollover options before you make a move is crucial, and seeking professional help before you make your move is advisable. Each investor's situation is unique, and speaking with someone may help you avoid costly 401k rollover mistakes and may help you make the best decisions possible for your financial future. If you have questions about rolling over your 401k, click the link below to book a complimentary 15-minute strategy session with one of our 401k advisors today.